can do. Rachel, what Rachel can do. Rachel, what can do, it says, okay, I will give you 5%, I'm making an example, 5% tax rate once a year on any lump sum invest with NSNI, so in bonds, in gilts, right? So if you are a British person, if you live in London, you live in Birmingham, wherever you live, in Leeds, in Glasgow, in Edinburgh, what Rachel can do? And she got a problem. Have you got a problem? No, you haven't got any problem. So they say, okay, I give you a, when you do business, you need to provide incentives for people to invest with you, to be comfortable with you, to trust you. Okay, so say, okay, if you are a saver, I give you a 5% tax rate. It may be that this stuff already exists, because of sure they will have some fiscal advantages for those who invest in with NSNI and stuff like that. But they should, for example, they could eliminate any sort of limits, upper limit for people who invest in sovereign bonds. Okay, they keep their saving, their life savings, their pension in government bonds. But at the same time, what Rachel can do is say, okay, I take capital gain tax. And I create an arbitrage. I say, okay, I put capital gains tax equal to income tax. Okay, what is 25%? I don't know what is the latest rate of income tax. Somewhere around 25%, excluding national insurance. With that, you create the incentive and the tax. You use the tax system to create a tax arbitrage. So any person, any XYZ person, will say, okay, if I have to invest into the UK, what the Treasury does, what Rachel does for me, it gives me a 5% tax on any lump sum that I invest in government bonds, and I keep the money there until the debt, for all the duration of the debt, what is 10 years, gilts, 30 years, the money stays there, nobody moves it, okay? They cannot touch it, okay? And you can do that in form of savings with NSNI and with pension funds, okay? It already works like that, yeah? This is a very well established industry. But what Rachel can do, they can provide a tax incentive. They say, okay, if you do business with NSNI, with the pension funds, I give you a 5% one-time tax on the lump sum that you invest. Okay, so every year the tax rate is 5% of your investment, or by the end of the time that you are retiring and you are withdrawing your investment, you will pay 5%. While instead, if you do a cash ISA, you want to invest into stocks, you will have to pay 25% capital gains tax, which is equal to income tax. Okay, so you create a constrictive, you have to create a nasty tax arbitrage and say, okay, so that you funnel liquidity into reserves, into bank reserves, not literally into bank reserves, but that pot of saving, you push the saving ratio higher, so that pot of saving becomes liquidity available for investment. What that means is that when people, they are saving